In the United Arab Emirates, the Federal Tax Authority, FTA, applies tax-related procedures. It introduced value-added tax, VAT, in 2018 at a standard rate of 5%. But what exactly is a value-added tax, VAT, and what do you need to know about its implementation? VAT is an indirect tax applied to an end consumer on the consumption of goods and services. It is charged at each stage of the supply chain based on the value added at each stage. So how is the VAT calculated? Every business has an input and output in its daily operations, taken as the basis for value addition. Inputs are external resources in the daily operations of businesses, like raw materials purchased, the labor involved, fuel expenses, or equipment costs. Outputs are revenue-generated outcomes derived from these inputs, essentially the final product or services sold. Businesses also deal with input tax and output tax in their own business transactions. They pay input tax to suppliers upon purchase of supplies, while output tax is collected from the customer on the sale of goods and services and paid to the government by the business. The payable VAT is the difference between output tax and input tax, while the remainder can be reclaimed from the government. Let's consider the example of chocolate production to understand where VAT applies. A manufacturer buys cocoa beans from a local farmer, priced at 5,000 dirhams. On top of this, the farmer charges a 5% VAT of 250 dirhams, since he must pay VAT to the Federal Tax Authority. However, cocoa is an input for the manufacturer. VAT here is considered as the manufacturer's input tax. The manufacturer processes the cocoa beans to make chocolate and sells it to the retailer at a selling price of 7,000 dirhams and an added VAT of 5% or 350 dirhams. In this instance, the chocolate is the manufacturer's output and the VAT charged on the output is considered the manufacturer's output tax. So, how much tax should the manufacturer pay in the end? The total payable tax the manufacturer has to bear is calculated by deducting the input tax from the output tax. In the example of our chocolate manufacturer, the resulting difference between the output tax collected from the retailer and the input tax paid to the farmer by the manufacturer is 100 dirhams. In conclusion, VAT is not a cost of business. VAT-registered businesses involved in each stage of the supply chain collect these taxes on behalf of the government. All registered businesses must file the VAT returns, though there are also a few goods and services that are 0% rated or exempted from VAT. Ultimately, the end consumers generally bear the VAT cost, while businesses collect and account for the tax, acting as a tax collector on behalf of the government.